Hi everyone, welcome to my channel. I am Mohammed Arif, a finance professional with over 30 years of experience in the industry. I've had the privilege of working in various leadership roles, focusing on change management, financial management, and achieving business targets. Don't forget to like, subscribe, and hit the notification bell so you never miss an update. Let's dive into today's topic of relative fair value method. When long-term assets such as land improvements and buildings are purchased, it is quite common for the purchase price not to separate out the amount paid for each of the individual assets. Unfortunately, the assets have to be depreciated at different rates. Land, for example, is not depreciated, and therefore, the relative fair value method is a technique used to allocate the total purchase cost to each asset. The relative fair value method is a way of allocating the total cost of a group of assets among the individual assets based on their fair values. Let us assume our company purchased assets involving land improvements, and building for the lump sum purchase price of $300,000. A step-by-step process of using relative fair value method for allocation of purchase price to the individual assets will be: Step 1. Determine the fair values. Assess the fair market value of each individual asset acquired in the lump sum purchase. The fair value is the price that would be received to sell an asset in an orderly transaction between market participants at the measurement date. Estimated appraised fair value for the three assets is: land $60,000, land improvements $80,000, and building $260,000. Step 2. Calculate the total fair value. Add up the fair values of all the individual assets to determine the total fair value of the group. The total comes to $400,000. Step 3. Calculate the proportion of each asset. Determine the proportion of the total fair value that each asset represents. This is done by dividing the fair value of each individual asset by the total fair value of the group. Step 4. Allocate the purchase price. The formula for allocation of purchase price is: multiply the lump sum purchase price by the proportion calculated for each asset. This gives you the allocated cost for each asset. The journal entry will appear something like this. Please also keep in mind that in addition to the long-term assets, the same formula or approach can also be used for services, where the service is also sold as part of a bundle deal or purchase. Thank you for watching this video.